Good evening, welcome to Futures Trading Alpha. It's the 5th or 6th of March, and you are currently looking at a live session trading of the 6EH19, the last day of the euro dollar, i.e. 6E futures contract, which is actually expiring tomorrow. So as we're getting so close to the contract expiry, where the price is getting closer and closer to the spot price, as it is the case for currency futures, and effectively, put more simply, the futures contract, as it comes to its maturity and is about to expire, is going to be really close to the price of the underlying. I had started a video this morning. I have 1 hour of video which I recorded and I wanted to post, and unfortunately I hadn't recorded the sound. So 1 hour of listening and watching is one thing and can be fairly long, but 1 hour of just watching with no sound is absolutely pointless. So I deleted it, and I'm running a quick one now. Sorry, obviously advantage and benefit is that this is going to be much shorter. I don't have the same energy I had this morning when I started trading. The drawback is I probably will not get into a trade now for various reasons, and it's a quiet time just now. It's the cash session, i.e. the US session as well, and I normally do not tend to trade at this time of the day, so I'm not going to get into a trade unless things are moving up a bit. Quite hard to recap everything I was saying within an hour, but effectively the idea is to, as my the announcement of the video on the channel is explaining, where the idea is to explain, share, organize webinars and training, and share experience, share what is working for us here. The idea being to generate alpha, i.e. generate return. This is not to necessarily recap or reiterate current order flow training that you will find very easily if you Google them up or if you look on YouTube. Some trainers, educators, and some coaches do that and have been doing that for a while. And really the idea here is to, obviously the concepts and what we do is similar, but it is down to, I think, everyone to take ownership of your own process, analysis, thought process, and functioning, generally speaking. And what I like to do is try to think differently, not for the sake of thinking differently, but try to think and ask myself questions when I do something, and when I hear something, and when I experience something, rather than just do it and take it as a setup. Now, the difficult thing about trading is not so much to everybody is able to learn various functioning of the order book, as you can see here on the right hand side. Everybody's able to understand the functioning of a footprint, and market profile and volume profile and other elements of what we're going to be looking at. But what is a bit harder to apply is to think about context. So everything is about context, and that's what makes trading difficult. We are being ruled by rules, obviously, in life, and things you do, things you don't do, things you can do, things you can't do. Green light, you go. Red light, you stop. These here, we don't have hard set rules. It's more applying a way of functioning to current circumstances, to the current, just what's actually happening now. That's the whole point of order flow. So you're analyzing the flow of orders, you're analyzing what's happening now. We want to try to assess who's in control, buyers or sellers, where is value, or at least where is perception of value, and are we in a bull bear phase, and effectively where, it's all about the supply and demand and the market auction theory. What applies here applies to any market. So any real estate market, for example, you sell a house, you want a certain amount for your house, some people are ready to pay another amount for the house. If this match, this is seen as fair value, there is a transaction, there is a contract. It's just the same as here. If it doesn't, then you can place a limit order and say, I want to, as it is the case here, for example, to sell 32 contracts. Obviously, this is just a random example. There aren't 32 coming from one person. We don't know how this is split out. But there are 32 limit orders here who want to effectively sell at 13,225, and when we get to that price, buyers will buy from the 32 limit orders at 13,225. And those who are more in a rush and want to buy, or as it is the case here, as you can see the market orders here, or sell, come at market and take liquidity which you have on the bid, so hit the bid or effectively lift the offer. So the principle is very simple. I've got my limit orders here, the bid, the ask, the prices, so the bid and the ask. I've got my volume profile here, and as I like to organize and look at market orders which are coming through here at the moment, as you can see, they also are adding up here on the footprint. So the footprint is very simply market orders which are displayed in a bar format with some information here which will allow us to visualize. It's simply a way to visualize better, or in a more easy way, along with the historical data, which will allow us to visualize effectively what's hitting the bid and lifting the offer. Hitting the bid and lifting the offer is precisely the mechanism of what makes price go up or down. So I will do other videos coming back on the DOM, and there are tons of training out there explaining how it works, explaining the spoofing, explaining all the gaming. That's not what I'm intending to do here. Some people are doing it. Some people trade the DOM. I don't trade the DOM. I use the DOM to trade, but I don't trade the DOM. I trade order flow. So, and it's my process is slightly different, but the technicalities and the way it works is the same. So in order for us to go from here to here, we need to consume all this liquidity. So market orders need to hit all this, consume all this liquidity at that level until we get there. Okay, there's no other way to get there. So, and likewise on the sell side, all the market orders who are selling are hitting the bid and consuming the liquidity in order to move the price down. Obviously, there are only two directions. Effectively, you can go down, so you can be bearish, or you can be bullish. You can go down or up, or I guess sideways, so not go anywhere, or just accumulate and distribute thereafter. So from there, I'm trying to record a few sessions. I'm trying not to make it last for too long, but this is one of the main dashboards of what I look at. And if I want to get into an order, and put an order and get into the market and say I do, just for the sake of the demonstration here, I've got a buy order here. It's one contract. So my order is being placed here, and from here I can see how the order flow is unfolding and whether I should take profit at some level or get out of the trade if the trade is unvalidated. So it's on principle as simple as that. And all of these, the footprint, the market profile, the volume profile, and all the other stats I'm looking at are purely here to help me confirm what's happening here. Now, the best way to, at least for me, to function is to have a bullish and bearish scenario every day before the market opens, and from this scenario I sort of try to assess that if it's bullish, if buyers are in control, if value is being perception of value is seeing higher, then where is it likely to go to? And likewise, if it's bearish, perception is seeing to have a, the value is seeming to be lower, going lower. Where is it likely to go to, and why, and how quickly? And if it does either way, what do I do, if anything? Because not doing anything is also part of trading. You can trade, you can go long, you can go short, or you can not do anything, not trade, which is also part of the decision making. Here I'm looking at a range bar, for example. This could be anything. It could be 15 minutes, 10 minutes, volume, it could be anything. This is completely irrelevant. It's just a way to display the market orders. And I only care personally at three things. I care about once there has been some move, I care to see what happens at the end of this move, or the high of the low of the day. That's all I care about. And the reason that's all I care about is not that it's the way to do it. There is no one way to do it. But I always feel that if I start looking at specific areas of a bar, so let's say I've got a 10 minutes or a 4 range bar, and I start worrying about what's happening at the top or bottom of the candles or the bars, well, what's the top of a bar now on a 4 range is going to be the middle maybe, or halfway through, or whatever the case may be, but it will not be the top of an 8 range bar. And the top of a 10-minute bar is not going to be the top of a 30-minute bar. It's going to be just right in the middle. So suddenly I care about what's happening at the top, and if I change just the way I look at it, so i.e. not what's happening, but just a way to look at it, then suddenly it's not the top anymore, it's the middle. And here I don't care about the middle, I care about the top. So why would suddenly start caring about the top, which becomes the middle, if I change the time period I'm looking at? So for that reason, I like to have real references, and real references could be following a move, following some order flow shift, following or shift in value, or shift in supply and demand. That's a valid fact, if you like, or a high or bottom of the day. So to take an example here, and it's example I was taking before I got cut off, I didn't have the sound. If I go back to the session today, here at around 1 o'clock, 1:30, we had a big move. It was velocity, there was intent, there was momentum, to the point that if you look here, in fact, we have a whole bunch of, so for those to whom it's not obvious, left hand side numbers are effectively sell orders, so they're hitting the bid, they're sellers, and on the right hand side they're buyers. Look here, it's so quick. There is little volume, but it's going so quickly that it is actually, there is nothing at all on the buy side. It's purely selling. When you have that, obviously it can only go one way, and it will only go one way. It's not a very frequent, it doesn't happen a lot. to that extent, but it's quite interesting to observe. So that's what happened earlier today, and I'm trying to go back to what I'd like to pay attention to as well is the volume per second, which again doesn't necessarily mean high volume. In fact, it often tends to mean not that high volume. But when there is momentum, velocity, i.e. speed, you tend to have some strong move, strong and definite move. So that's quite interesting things to look at. If I go a bit, because I realise I've been a bit too far backwards here, so let me just go back to today. That was last week I was looking at, but it doesn't matter. The example is still the same, still valid. So today, at 1:30, we had, fairly enough, seems to be quite a lot of move at around 1 o'clock, 1:30, and is very often linked to economic announcement. You can see this big sharp move. And if you look at this big sharp move, you can also see 800 volume per second, 659, 228, 621, 213, 148, 242. This is quick. I mean, I'm looking at a 60. I know the 60. I've been training the 60 for 10 years. This is quick. This is fast. This is velocity. This is momentum. This will in that case, I was a fairly bullish. And he's going in one direction, and there's no way this is gonna, it's like catching a folding knife. He's going in one direction, and he'll stop going. So when we get to the bottom of the day here, there's two elements here. There's this first strong speed, quite volume as well with the speed, and all things being relative here, guys. By the way, it's 1348 is volume for a 4 range bar 4060, as opposed to 447, which is probably more normal. So when you get volume, when you get velocity, when you get momentum, when you get the low of the day, and when you get a here unfinished business, i.e. there's no zero here, as you can see, that's the as in here 330, 010, 30. There isn't here, and there isn't here either. Actually, when you do get that, this is unfinished business. It's an unfinished auction. All right. The fact that there are 3 and a bunch of contracts at market buying here means that this 3 here is not. Again, it's all contextual. It's not that huge, but it still means that against these guys here, the 3 market orders, there are still people in a limit order who are there, position, obviously, to sell, because in order to buy 3, you need to find 3 to sell. It's 3 for sale, you buy from. Likewise, you got 23 here while selling. They're selling at market. So very often when you get to a bottom of a session of a day like that, you find stops, and these stops accumulate and they create market orders. Obviously, I'm in a long here, for example. Okay, that's a buy order. If I get out of my buy now and I click, I hit flat or cancel or whatever, it's going to become a short, so a sell order. And in order to match this sell order, I will still need to find a matching limit order is buying. So we never know if these are stops or if these are really intentional, i.e., initiating trades, or just responsive or just getting out of trades. We don't know. But normally, when you have data on both sides, it's what's called unfinished business, and something to pay attention to if we get back to that level. Likewise, when we hit the top of the day, which I think was 113.36, and was today was here. No. Sorry, I'm trying to find what time this we reached the. I think it was later in the day actually. Sorry, I'm just trying to look at my other charts and later in the day. There we go. That's the high of the day. So if you look at the high of the day here again, and I don't want to do a whole unfinished business video, that's not the point. But you can see here we've got 17, 116. The fact there are 17 buyers is not a shocker. As a, you know, there could be all stops. There could be people actually. Also, there's quite a stack up of orders here. There's a good number of them, and here could be just you know, like people were long, and they getting out of the trade, so getting short here, or it could just be people shorting the top of the day. Nothing unusual here. What's more, you have to think about the other side. The other side is limit orders buying. So why would limit orders buy at the top of the day? Is it exiting position and they use limit orders as a format? That can be done. It's a different type of order. Or is it, does that mean that it's actually buyers we need to find, they want to buy at that level because they're not at all on the same sort of time zone or frame of mind or setup as us? So you've got hedge funds, you've got pension funds, you've got insurance funds, you've got private bank, you've got wealth managers, you've got speculators, you've got all kind of hedgers, you've got people leverage, you've got people arbitrage. There's tons of players out there, and retails and so on. So we do not know everybody's agenda, and we don't really care, to be quite honest. We don't care. All we care about is to say, look, there is unfinished business here. So it could well be that if you want to get out of positions, or if you want to buy very simply at that level, because what you're looking at is not the day, it's not the current days, is your time frame in 3 months, 4 months, 5 months, 6 months, 2 weeks, I don't know, and I don't care. I want to do that when there is liquidity. Where best to find liquidity but of an extreme of a day, at an extreme of a day, because at the extreme of a day there will be stops, there will be people shorting. So if there's plenty of people shorting and some shorts and some long shorts up there, then that's a great nest of liquidity. So if I want to buy, I come here, so I'm going to be putting my limit orders and I'm buying. Or it could be something completely different, but the point being, there is unfinished business here. So on this side you've got the short finds some limit orders who are buyers, and you've got people who are long here, market orders. Again, we don't know if they're long because they're getting out of shorts, or they were short somewhere else and now they realize, God, this is going against me. So these are stops, or people coming out, or if people intentionally initiating trades here being long for whatever reason. Again, it doesn't matter, but there will be some people here who are stuck. They're the wrong way around, and if, as we speak now, because you know you're looking at 113.36, we're on 113.21, so they not dramatically the wrong way around, and it could well be that their strategy allows them for that sort of cushion, and the risk management is, you know. But when we get back to that level, there will be some reaction. So all that to say that what I tend to look at is to use context, to use reference, and the reference here is a high of the day, it's a low of the day. It's following some move, following some effectively distribution, following a shift in value, following something relevant, and not just something which relates to my arbitrary choice of displaying data. Again, that's me looking at it this way. If it makes sense to you, it's fine. If it doesn't, it's also fine. I'm not saying it should be done one way or another, but this has nothing to do with trading. If you think about it, it is purely sort of what makes sense. And it does make sense to have reference which are the same reference for everybody, not just my own references. So there we go. I mean, it's also a whole. There will be a dedicated video for the footprint, because the footprint some people only trade from footprint, so it's quite detailed. There's tons of information out there. You've got deltas, you've got bar duration, you've got cumulative delta, you've got a max delta, the minimum delta, there's obviously the volume as well, because we talked about the speed of the volume, but there's also the sort of level of the volume. There is a lot to be taken on board, and there's imbalances, which I don't really look at personally, but that's something that can be used as to how the volume is displayed, within the bar. And again, this is related to the bar, so I don't really look at it until it's following some relevant, event. But again, I think that's these two tools, sort of the order book is the essence of what makes the market move. The footprint is really part of it, because it's the market orders. So that these two elements, plus a lot of other stats, plus the volume profile and market profile, to sort of help to have references, which I look on daily, weekly, monthly, put together, try to look at the sort of overlapping and concurring sort of areas, will give me areas of interest. So I'm just going to pause this now. I'll probably finish a little bit more on that side, the footprint and the market profile and the volume profile. But really, it's just scrapping the surface, and I will go back into more trades tomorrow. But I will finish in a little bit more on the actual market profile, TPO, and the volume profile. So having paused the recording I was doing last night, this is actually the 7th of March now, and it's 7 a.m. GMT. And I wanted to carry on. There was nothing very much interesting yesterday. It was fairly quiet, being, as I said, part of the time of the day I never really trade, and in addition to that, it was fairly slopey, and we actually had an overnight session which was has been slightly down, as you can see here. As you can see here, but we remain within value, and that brings me to another side of what is part of the order flow, but certainly what is part of my analysis and process. And what is part of my analysis process is, we looked at the order book, we looked at the market orders versus limit orders, we looked at the order book itself and the footprint and the various analysis we can get out of this. As I said, there is much more to talk about when it comes to the footprint. It's actually a great little way to analyze market orders. And in fact, if you look at what we keep hearing about algos and so on, and they mainly, a lot of them do analyze market orders, limit orders, the relationship between the two, the volume, momentum, and that's pretty much it. As much as we want it to believe that it's super sophisticated, yes, it is. The technology is there, the speed is there, but in practice, explaining that is not actually, when you look into algos, and I have worked for a number of years as a professional, as a broker, and also working directly with a great number of trading floors. I can tell you that yes, there is the sort of leverage, and when it comes to size and money and people work there and what's available, but nothing is actually very complex or complicated. At least not much more than what we do. It's probably much more simplified in a way, and being an institutional trader will certainly not make depends where, but in an execution broker will not make you necessarily be a good proprietary trader, because we're looking at things completely different and very basic, unlike what we think, and unlike all the secrets we think that these big firms hold. The only secret these big firms hold is leverage of money. That's it. There's nothing else to it, and that buys a number of things, and that gives obviously a number of leverage, and that offers opportunities we don't have. But I don't think there is anything more magical or secret, or no more holy grail than there is anywhere else. So, having said all that, here, for those who are not familiar with it, and I will come back to it, not because there is a lack of volume profile and market profile courses out there. Some firms do it online, some firms do it, have actual offices in New York and in London and wherever else, and you can go there and you pay money and you sit on the floor for anything from a day to 2 months or 3 months, or be there all the time, rent a desk. I don't know, I can't think of all the options that they are. Some, by the look of it, I don't never been to any of them, but some, by the look of it, who do tend to advertise some of their videos and trading sessions, as I'm doing here, who do that online, seem to be really good, if I'm honest. At least that's my opinion. Some, and of course there's a lot of other things which I don't look at because it doesn't talk to me, so to speak. It's not part of the spectrum of things which I feel would add value to me. So and knowing what I know, at least. So I think it's down to everyone to discover their path and understand where they're going. What's for sure is I do not look at what is called lagging indicators. So lagging indicators is very simply a moving average, for example, or an RSI or MACD, or all the things. Some people will argue that they use it and it works marvelously and is great. Fine, it just doesn't work for me. As long as the actual logic behind it doesn't agree with me, I can't. It doesn't click in my brain, and I can't reasonably agree that yes, this is adding value, and yes, this makes sense. Again, to me, it doesn't mean it doesn't. It just means to me, then I choose not to use that. And looking at past data to forecast futures data is not part of what makes sense to me. But again, if that works, and if you do something like that and it's fine, then don't change something which is working and which is fine. There's no reason to do it. So all the tools I'm looking at are volume based, are order flow based, i.e. I'm looking at the order as they unfold and the exchange of contracts as they unfold, and the value as it shifts, and the supply and demand as it is located each day, or located, where it's priced every day, shall we say. And this is how I generate alpha, i.e. return and performance, and we'll get back to that I'll brush on that as well in other videos. I mean, I like really to question everything, and that brings me to sort of statistics of how people always ask, well, what's your winning rate and ratio and this, and which again is completely irrelevant. And that's not just an effect of doing some nice Excel calculations and statistically show and prove to somebody that this is what's happening. And no, it just don't need to go that far, and there's no need to go in that detail. I've seen calculations out there and people showing that it doesn't matter, and it doesn't matter, but or it's not relevant. I.e. you can have 30% winning rate and 70% losing rate, so to speak, and still make money. And the opposite, as in 70 or 80, or I've seen people 80, 90 winning rate and still lose. So that's completely irrelevant. That's something that was made up and created by brokers who want to, again, throw smoke and mirrors and nice things to people and track them. It's just completely, nobody would look at that in the real world. But anyway, that's for another video. Here, what we're looking at here is obviously, as I said, I'm not going to go and explain now. Could be done in my way. They are obviously massive experts at the TPOs, market profile, is this profile that you see on the left hand side here, and it's, as you know, split into 30-minute sessions. So since the opening of the session, we've got 30 minutes, 30 minutes, 30 minutes, 30 minutes, 30 minutes, 30 minutes, and it's defined, as it is the case most of the time here, by letters. It could be colors, but it's letters. So you know that O is, since A, you know, A, B, C, D, E, F, G, and so on. And that just gives you, again, I'm not going to do a market profile. There are some proper experts at it out there. I don't use it. I don't do it any justice. To me, it's still part of a. It's very useful. It brings me some information, but I feel it is still, again, all things being relative, it has a lagging effect to it. So I wouldn't make decisions based on that, but it certainly does confirm a number of things, and it's certainly very useful. And I'd love to learn to be able to do it to level, as some people do seem to only use that. It's getting rarer and rarer, but there are some master guys over there who do it. Mainly one chap, but it's clearly quite powerful. But it just gives you an idea of having a profile. Where are we, or have we spent the most time so far? So here we can see the red colored letters. The TPOC is time. It's the TPO, effectively point of control. We have spent the most time here so far today. Bearing in mind it's the end of the Asia session, and we will open the London session in an hour, or in 45 minutes. And this is where, that's the volume profile. So that's volume based, that's time based. We compare the two, and here it's telling me where the volume has been, as opposed to having the volume, you know, down here. It's on the per price level. It's telling me that the point of control in terms of volume is here. So you can see the time spent in this bell-shaped area and balanced area is the pretty much where the volume has been done. So here, volume and time match, which is not always the case, by the way. Yesterday we've got a fairly balanced volume, symmetrical TPO as well. So volume and time matched. In fact, you can see both TPOs matched pretty much. If you go back in time, here we've got this massive low volume node here, but the two profiles matched likewise. But don't think this is the case all the time. I mean, here we've had days where these things to, I mean, time and volume coincide. You will see differences as well as you look at various different contracts. But here I'm just exclusively looking at a 6E. I don't have a good example here, but you know, if we want to find some cherry pick example, we will find examples where the market spent a lot of time at some stage, but didn't generate much volume. So you know, there was no real interest as such. There was obviously the time was spent, and that would indicate different things. So if we spend a lot of time in an area and we generated volume, that means this is where the value was perceived. This is where the market spent time exchanging contracts and trading effectively. And so that seems quite logical. Sometimes you will see a place where not much time was spent and volume was created, generated, which means that some would suggest, if we haven't spent the time, that the little time that we spend there, some bigger orders probably, or bigger, i.e. creating is high volume, we're talking about larger orders. And sometimes you will spend a lot of time somewhere and don't really exchange any contracts, don't really create volume. That's more, you know, a day where the market is pausing, is waiting for an announcement, is waiting for a decision, and is waiting for something, and there's no real incentive to trade, and it's just pausing and waiting. So yes, these are, you know, the time and volume not coinciding. It is probably a less frequent occurrence, sorry, but it does happen. Now here the interesting thing I tend to do, and I'm not going to go into detail now, but it's just looking at the open, see where we open in relation to yesterday's close, see what happened, see if the first hour, it's only half hour, but hour, we've got the opening range here, as you can tell, as well as the initial balance, and try to, all these is, we can go through it, but you will find this quite easily. Here the idea is just to show a quick process more than get into details of things, but you can see that we open within value effectively. We go through yesterday's value area in green, through as in from the top to the bottom, pretty much the bottom, literally quite exactly the bottom. And is value at this stage, at this point in time, at 7:20 AM GMT, is it in below yesterday's value? No. So we bounce back, we come back here, and now we're back within, not within the middle, but we're back within the yesterday's value area. So I always look at previous day's value area. This is daily TPO, so daily market profile versus volume profile, with longer term volume profile on the right hand side here. And I also look at the same thing for weekly and monthly. And I tend to pay attention to areas where we will have overlap between different time frames. And again, the time doesn't mean anything here. The market has no time. Market is about value, it's about perception of value, it's about people exchanging contract. It's not, we decided to put in a time frame because we tend to sleep at night and be awake during the day, and therefore there are sessions, and depending on the market you're looking at, there's opening sessions and there's opening times and closing times, a bit like a shop. So because we're human beings, we come in a shop, the shopkeeper has to go to bed at some stage, and or not, or we'll be replaced, and there's a shift and there's another guy taking over, and whatever the case might be. So it's just because we're human and we decide to put it this way, and that's the only interest of looking at various sort of time frames. It's because you fall into this sort of human, and it's not value here. I mean, it's more human generated sort of setup, not setup, but point of view. So now, when you start a day like that, when I start a day like that, obviously I have no idea until the London session has started and so on, but yesterday, or the day before yesterday rather, we have a low volume node. You can see that we went through all the way up to this low volume node, and we generated some volume here, not a lot of it. I'm not sure, there isn't much to be done up here. Probably is. And in fact, if you don't mind, I just got a trade on. I'm looking where we are. Okay, so we're just above this trade here. Sorry. So yeah, so we're so one there are three effectively scenarios to be had. The first scenario is we go up. The second scenario is we go down. The other scenario would be to go sideways, as in accumulate. So it is accumulation, distribution, up or down. Simple. Not 4, 3. So not getting into the market, as far as we're concerned, is one option. Getting in long is another one. Getting in short is also the third one. So not getting in is also part of trading. Not deciding and actively choosing not to get in is a decision, is trading. Now, the second question is if, and the big trap is to start saying, oh, I think the day before yesterday we had a low volume node, and I think we're going to go up because X, Y, Z, and yeah, that's for sure. And if we do, it's no bias. If you start having a bias, you're in trouble, because invariably it won't happen, or it looks like it's going to happen, and then it reverses and it's completely the opposite of. So have none, but have the two scenarios. That's what I do. I'm not saying you should necessarily do it, but that's how I do it. So with that in mind, my first objective here would tend to be to go back here in that example here. So go back to these 32.28. If we're up, that's the original. So that still implies going back all 2 days profile all the way up and going all the way up here. That would be my target number 1. And my target number 2 would be yesterday's top, because not because yesterday's high, but because it coincides as well with the high of the volume nodes here, and we could go all the way back to this Tuesday's point of control, and so that would be. And again, it could it's just an initial scenario. It could technically go. There is a lot of massively. It's effectively there's a very low volume node here, and a quite a, we could call it a whole. It's not a selling tail per se, in the sense that it's the whole area here is. Look at the shape of this profile is sort of at a shop, and I think we could quite go at some stage back all the way to 1390, and then as you go back to 1390, why not go back to 14, and so on. So we've got a rolling contract as well coming in. You have to, it's the end of the March contract, so soon. So again, things to take on board, but these would be my initial targets if that's what's going to happen. Equally, we could, as I said, do nothing and wait for whatever, or the other option, which is also fairly likely. I can see here, to me, this profile here, the bottom of this profile, and the same applies really on the market profile. We have to me, this is a poor low. I mean, i.e., this business is not finished here. It's something to be done here. You see, it's not complete auction. At the same time here, we've got this big buying tail. That one is quite clear. That will be, that's the target. This sort of 29.96. So if I was to start to think that we're fairly bearish as opposed to bullish, then I wouldn't make that decision until we're somewhere out of this, getting out of yesterday's value area. But if we did, then I probably would be aiming at here, somewhere here. It's not a specific level, by the way. It's an area we're looking at. Now, as you can see, I draw all these lines, or these colors are, and I need to completely refresh the whole thing because it's been done a while back, and now it looks like a massive. It's like a painting. But I would see. I've got as well. That's the. I've got the. Let me just clear. Trying to clear all the, because I need to redo everything and refresh. It's important to refresh every day. I mean, not every day, but I tend to do it quite often. In the sense that, yes, some areas are here to stay until we get there, but I'm trying to delete all the erase all the lines in here. Which I can't find just now. Anyway, point being, there's some zones would need to be. Everything which is in blue here, as you can see in my chart, is areas which I have drawn myself, coming from the weekly profile. Anything which is in brown is coming from the monthly profile, and I need to completely undo this. Let me just pause and so I've undone all the areas I had drawn onto the monthly and weekly profile. So now we've got a chart as you would have, and as far as this daily profile would be, the way I would draw my areas of interest. And again, my areas of interest, it doesn't, there's no hard set rule, and because I'm used to it, I'm doing it perhaps in a way that, but I would certainly certainly this would be one, you know, here. So I would go here and say, well, when we get to that level, I want to pay attention to that level and project it forward. So that's a good, you know, that's a good way to look at it. Here I've got a poor high, as you can see, you know, and on this poor high is, again, it's something I would got poor high, poor low, and you know, as far as I'm concerned, this is not nice. This is something we will revisit. Again, it's a, you know, it doesn't have to be precise to the point of being something that has, when I tend to as well mark when something has been done but not sure if this has been fully worked on. So I would, again, something I would highlight. So there was in other words, there was a low volume node the day before yesterday. We went there, we didn't do the business we should have done. There might be some more to do. All low volume nodes, to be clearer, are originally will be a point of rejection, and then until it's accepted. It's rejected until it's accepted, and until it's being worked on, and until value. It's all down to value. This value is being perceived to be here, and if there's an area where we spend little time, we will visit it. That's how it works. Market will go back to it and exchange contracts. We don't know when it will, and I probably would have one here. Okay, that's just on yesterday. Obviously, you have to do that throughout time and look at those who are relevant, those who are not relevant. Do it for the weekly. We'll do it for the monthly, and try to have see where it overlaps and the sort of confluence zones. The video is 52 minutes. I'm going to stop now. It's 7:30. I will maybe post a quick one later on today or tomorrow. Thank you very much if you managed to watch and to hear. I'm sorry about the interruptions. The one I had started yesterday morning was actually, there was no sound, but it was actually much more interesting because the market was moving. It was later on in the day. If you have any comments, if you have any questions, if you have anything to share, anything to, please, this to share in a productive way, sort of. So don't hesitate. Thank you very much, and let's discuss how to generate alpha.